So we're going to look at Teleflex, and what we're going to do is a discounted cash flow model so we could figure out what the value of the stock is based off of their financial information. And this company is located in Pennsylvania, and what they do, they provide specialty medical devices for a range of procedures in critical care and surgery. And it seems to be traded a lot today, so I wanted to just look at it because I haven't really delved into the numbers for this company before. So the market cap is 16.25 billion and the stock price is 350. It's a hefty stock price. So that implies they have 46 million shares outstanding. And when we calculate the future cash flow, we have to discount it back to today's dollars and then divide the number by 46 million to get the stock price. And if the stock price we calculate is above 350, we consider the stock a buy. And if it's below 350, we consider it a sell. And so all analysts on Wall Street do this type of discount model. They calculate the free cash flow and then they discount it back. Even Warren Buffett does this, but they get into a little deeper, I'm sure, because they have a lot, maybe more information. I just use the numbers, and I use some of my knowledge, but I try not to let the news influence me too much because you can go either way on anything. Every time I post a video, I get people who say, "What about this and that and that?" And they list all these positives, and people list all these negatives. So you really don't know. So let's bring in their revenue. So they have a pretty consistent free cash flow, which is interesting. And net income, it was a nice pop in this current year, 2019. And the revenue seems to be on an upward trend every year. So it looks pretty good so far. But what we need next is we need to find out the discount rate. And we do that by calculating the WACC. And every company has a different WACC. It's all based on how much it costs this company to borrow money. So the interest expense, that's the interest they pay on the debt, is 80 million. And let's see how much debt they have on the balance sheet. So the current debt that's due within a year is only 50 million. So it must be almost all in long-term debt, which is debt due beyond 1 year. So 4.2%, a decent interest rate. And now their income before tax, because we need to find out the effective tax rate. See, this is why it's always hard to look at an income statement. They made $339 million before taxes last year, and they got a refund of $122 million. So obviously, if you make that much money, you shouldn't be getting a refund. The reason they got a refund, which they probably clawed back losses from prior years, or there could have been something else going on. We need to look into the 10K, but I'm not going to go into that type of detail because prior years' effective tax rates should be appropriate. It looks like 2017 is the best, but that looks like it's pretty high, the tax rate. I'm going to just force a 20%. It's all over the place. I mean, look at the tax rate on this. It's under like what is it, 5% or 6%? It's really low there, even less. Let's just do a 20% tax rate because it's going to be too funky if we use this negative taxes that they paid. And the reason we do this is because you get a tax deduction on the interest on your debt. So even though they paid 4.2% interest, they get deducted 20%, and now it's 3.36%, the interest they paid on the debt. And we need to figure out the cost of equity. And we do that by looking at the beta, and they have a good beta. It's under 1. It moves about with the market. So when you combine the debt, cost of debt and cost of equity, and you apply it to the weight of debt, which is 11%, the weight of equity, 89%, you get a weighted average cost of capital of 9.16%. So it cost this company 9.16% to get money, to borrow money, whether they get it from bondholders or equity holders. So when they operate their business, if they're not at least making 9.16%, they're losing value for the company. So that's something to think about when you invest. Like, is a company you invest in operating above what their cost of capital is? If it's not, it's just losing more value every year until eventually it's going to go out of business. So what we did was we were able to back into the future free cash flow by using the financials I input earlier, and we calculated a future free cash flow of these numbers for the next several years. And then we discount those back to today's dollars, which is right here. And then the sum of the entire company, according to our model, is $9.6 billion. And with 46 million shares outstanding, that implies the stock price should be $206, but it's trading at $350. It's trading at a 70% premium. Now let's just look at the stock price the last few years. It's $350, so it's trading almost at its peak. I mean, it seemed like it peaked right before coronavirus in January, February. But where's 206? 206 is right here. So it looks like it was trading at Trinsic in 2018, maybe early 2019, but then it started trading at a premium to intrinsic. And the reason stocks trade at a premium is because people see the future of the company as more profitable and more beneficial than the current financials, the past. When a stock sells at a discount, people see the future as worse. So they're not even willing to pay as much for the company as it's worth. So this is something to think about, and this is just my opinion on this particular company. It's my discounted cash flow model. I didn't put into any assumptions on how the medical device industry will perform the next few years. No assumptions like that. I just took their numbers and calculated their intrinsic value. And tell me in the comments what you think and what would you do different. And if there's a company you want me to do a cash flow model for, please let me know, and I'd love to do it.